Hi, I'm Jared Eaton and welcome to Ask the Experts. Today's expert, Greg Moore. Greg is an experienced taxation advisor with extensive experience in public practice, commerce and academia. Greg is the director of Moore Consulting, a taxation consulting firm located in Western Australia that provides a range of successful businesses and high net worth individuals with accounting and taxation services and advice. Do you believe property investment is the best way to generate personal wealth?
In combination with stocks and cash, certainly. Property is one of the major components. It's good to be diversified between lots of assets because in certain circumstances assets go up and down, so nothing is foolproof, but yes, definitely one of the major components.
In your experience, have medium to long-term property investors been able to make a good return?
Yes, they have, Jared. On average, property doubles every 7 years, so you can imagine holding a property for 20 or 30 years, the value would appreciate quite a lot.
What could be claimed in regards to improvements, maintenance and depreciation?
Depending upon what the expenditure is, certain ones can be claimed upfront immediately. So any maintenance or repairs, as long as it's not of a capital nature, can be claimed straight up. Certain assets costing over $300 or improving the structure of the building, we can depreciate over a number of years.
So from a property management side of things, are the management fees deductible along with advertising for a prospective tenant with internet marketing, newspaper marketing, signage? Are they all deductible?
Yes, Jared, all of those things are directly deductible when advertising for tenants because rent is of an income nature, so we can definitely claim those deductions.
Is stamp duty deductible?
Stamp duty is not deductible. Stamp duty gets caught up in the capital gains side of things. So the stamp duty will increase the cost base, which will reduce the capital gain, which means less tax payable.
So really, what are the benefits of owning an investment property?
From a financial perspective, it's twofold, Jared. Firstly, the rent that you receive from the property. Secondly, the appreciation in the value of the property. From a lifestyle perspective, owning a property will help you build your wealth and live the lifestyle that you want to.
So if you already own a property, can you use that in order to help get finance to buy an investment property?
Yes, it can, Jared. If you've got equity in your existing property, you can use that to purchase another investment property. In some circumstances, you won't even need to fork out an additional deposit using the equity in your existing house. Most banks will lend up to 80% of the value of your home. So if you've had your home for a number of years, you can use the equity or the appreciation in that property to assist you buying your next investment property.
And how do you know when the time is right to buy an investment property?
If I knew that, Jared, I would be very, very wealthy. If everyone had a crystal ball and could gaze into the future and say when the best appreciation was, that would be amazing, but unfortunately we don't have that. Some people have the opinion that the best time to buy is now, as on average property will increase slowly over time. So trying to estimate when the best time to buy and time the market for some people may not be the best strategy. So best time is usually now if you can afford it.
How can you calculate just how much you can or should spend on an investment property?
It depends upon each individual, Jared. It depends on their risk profile. Some people are more interested in taking on more risk and some people are interested in taking on less risk. So you can think of whether you can afford to keep the property if it goes down by 20%, whether you can still hold the property or whether you'd be forced to sell if certain things happened.
What is negative gearing?
Negative gearing is where your expenses exceed the income for the property. The benefit of this is that you can claim a tax deduction for that net loss against your income that you're earning. The detriment is you've got to find the additional cash in most circumstances to fund that.
And what's positive gearing?
Positive gearing is the other way around, where how much income and rent you receive outweighs your expenses. Positive gearing, on the other hand, is good because you receive additional cash and it's cash flow positive, but you have to pay additional tax. So this negative and positive gearing ties into who the best owner of the property is. If you're receiving additional income or you're receiving additional deduction, the marginal rate of tax of whoever owns the property or receives a distribution, etc., is a very important consideration.
Can you minimise capital gains tax?
Yes, you can, Jared. The most important step is to decide who should be the owner of the property, whether it should be an individual, two individuals together, a trust. A company is not normally the best option, but can be one, or even a self-managed super fund has the option to buy a property.
And I understand a property investor can benefit from a 50% reduction in capital gains tax.
Yes, Jared, individuals can get a 50% discount in capital gains tax if they hold the property for 12 months or more. Also, if a trust makes a gain and distributes it to an individual, that individual can access the 50% discount. Companies are not eligible for the 50% discount, and self-managed super funds get a third discount if the fund is in accumulation mode, so it gets reduced from 15 to 10%.
Finally, what are some of the key things a potential property investor needs to be careful about and consider before buying an investment property?
Getting expert advice is the most important thing that you need to do, Jared. Building a great team around you of people who are experts in their fields and know what they're doing is the most important thing. So we need to have a real estate agent who can advise on the real estate side of things, a conveyancer to help you with the settlement, perhaps a lawyer, a banker to help you with your financing needs, and an accountant or taxation advisor to assist you with your taxation side of things. The most important thing from a taxation perspective is to choose the correct owner. This could save you significant amounts in capital gains tax over the long term and could be better for you than negotiating hard on the property or saving a few points on your interest rate.
Well, Greg, thanks very much for joining us on this episode of Ask the Experts. If you're needing any taxation or accountancy advice, feel free to contact Greg direct. And thank you for joining us on this episode of Ask the Experts with Jared Eaton.